In early 2026, a number started circulating through financial circles that didn't quite behave like normal data. It wasn't surprising in the way strong earnings are surprising. It wasn't shocking in the way a collapse is shocking. It was something more unsettling. A figure that felt disconnected. $1.75 trillion. That's the valuation being discussed around SpaceX's upcoming IPO. Alongside it, another number followed almost casually. $75 billion expected to be raised in a single public offering. On paper, it looks like momentum, but when you compare it to the underlying financial reality, the contrast becomes difficult to ignore. Around $18.7 billion in annual revenue, and a reported multi-billion-dollar net loss when including consolidated AI operations. The gap between those numbers is where the story actually begins. Because somewhere between what exists today and what is being priced for tomorrow, the system starts to stretch. And once it stretches far enough, even insiders begin asking a quiet question. What exactly is being valued here? To understand how this point was reached, you have to look at the structure beneath it. Because it isn't really one company anymore. It's a network of interdependent systems. Tesla operates at the surface level, building electric vehicles and pushing toward autonomy and robotics. SpaceX sits beneath that, handling launch infrastructure and satellite deployment. Starlink extends that into global communications, already generating around $11 billion a year in revenue. And then there is xAI, which ties artificial intelligence into the entire structure. Each layer depends on the others in a way that makes them difficult to separate. Rockets deploy satellites. Satellites enable global connectivity. Connectivity feeds AI systems. AI systems justify further infrastructure expansion. It becomes a loop where each success reinforces the next assumption. And over time, that loop becomes financially powerful. Because investors are no longer evaluating individual businesses in isolation. They are evaluating a system that appears to expand in every direction at once. For years, that narrative held because parts of it were undeniably real. Reusable rockets changed launch economics. Satellite internet became operational. Electric vehicles scaled globally. But as the physical progress continued, something else began accelerating faster. The expectations. What is happening here is not a traditional fraud structure with clear falsification points. It is more subtle than that. It operates through projection. Real revenue forms the base layer. Starlink, launch services, and existing hardware create tangible financial grounding. But above that layer, something different begins to form. Future technologies start being treated as if they already carry measurable economic weight. Autonomous vehicles that are still not fully deployed. Humanoid robots that exist primarily in controlled demonstrations. Semiconductor systems that have not been physically built. An orbital computing infrastructure that exists more in modeling than in production. Each of these is assigned implied value. Not because they generate cash flow today, but because they are assumed to generate it later. This is where valuation begins to detach from execution. Because once future systems are priced as present-day assets, the present becomes stretched to accommodate them. And that is how a figure like $1.75 trillion becomes justifiable in narrative terms, even when the underlying infrastructure has not yet reached that scale. Inside semiconductor discussions, for example, the proposed fabrication system known as Terafab introduces even more complexity. It assumes the ability to produce advanced chips for vehicles, robotics, and AI data centers within a unified industrial environment. But in reality, semiconductor manufacturing is one of the most specialized industries on Earth, requiring decades of refinement and enormous physical infrastructure that cannot simply be condensed into a single facility or timeline. And yet the projection continues to expand. because each new layer reinforces the one before it. As these projections expand, internal inconsistencies begin to surface. Timelines for autonomy continue to shift further into the future. Robotics demonstrations rely heavily on controlled conditions that do not fully reflect operational reality. Satellite internet, while successful, begins to show signs of natural market saturation as the most accessible customer segments are gradually captured. At the same time, the more ambitious projections begin to dominate the narrative. Orbital AI systems are described in terms of massive energy consumption targets that do not map cleanly onto existing global computing infrastructure. Semiconductor expansion is framed as a vertically integrated breakthrough, even though the industry itself is dominated by highly specialized manufacturers that operate on decades-long development cycles. None of these are direct contradictions on their own, but together, they create a pattern where execution and projection begin moving at different speeds. And that difference becomes difficult to ignore in financial review discussions. From the outside, nothing appears to be happening. There are no enforcement actions, no public investigations, no official disputes. But regulatory processes rarely begin with visible confrontation. They begin with questions. In IPO review cycles, especially those involving highly complex forward projections, regulators focus less on whether ideas are ambitious and more on whether assumptions are clearly disclosed and defensible. That distinction becomes important here, because when assumptions involve technologies that do not yet exist at scale, the line between disclosure and interpretation becomes harder to maintain. Internally, discussions reportedly begin circling around how certain valuation models are constructed, particularly where AI infrastructure, cross-company integration, and long-term compute assumptions intersect. There is no conclusion reached at this stage. Only a growing awareness that the distance between current performance and projected scale is widening. And in regulatory environments, widening gaps rarely go unnoticed for long. Even when nothing is formally challenged, the questions remain recorded. There is no sudden collapse in this story, no dramatic failure event. What exists instead is a slow convergence point forming around the IPO itself. On one side, there is real infrastructure that produces real revenue, launch systems that dominate global markets, satellite networks that operate at scale, manufacturing systems that already exist and function. On the other side, there are projections that extend far beyond current physical constraints, AI systems that require infrastructure not yet deployed, semiconductor ecosystems that assume manufacturing capabilities still in development, and orbital computing concepts that exist primarily in theoretical modeling. The tension is not between success and failure. It is between what is already built and what is being priced as if it already exists. And in modern capital markets, that tension does not resolve instantly. It resolves through repricing, sometimes gradually, sometimes sharply, but always structurally. Because valuation is not fixed. It adjusts to belief, and belief adjusts to evidence. When the two diverge far enough, the system does not break. It recalibrates. Behind every projection sits a network of real commitments. Capital allocated based on long-term assumptions. Engineering teams building systems that may take decades to fully mature. Supply chains expanding in anticipation of demand that exists first in models before it exists in reality. And when those models shift, the effects do not appear as a single event. They appear as delays, as reallocation, as recalibration of expectations that ripple outward through industries that were built around them. It is not immediate collapse. It is gradual adjustment. But for those inside the system, adjustment can still feel like disruption. What makes systems like this difficult to unwind is not deception. It is reinforcement. Every milestone strengthens belief in the next projection. Every projection attracts capital. Every inflow of capital reinforces the credibility of the projection. Over time, the system begins to stabilize around its own expectations. Ambition stops being separate from obligation. Forecasts stop being separate from strategy. And at a certain point, the distinction between what is planned and what is assumed begins to blur. That is where momentum takes over. Not because anyone loses control, but because the system itself becomes self-reinforcing. What this story ultimately reveals is not a single company or a single decision point. It is a broader shift in how modern markets interpret time, where value is no longer anchored only in present output, but increasingly shaped by projected systems that may or may not arrive on schedule. And once that shift occurs, the most important variable is no longer what exists today. It is how much of today's value depends on tomorrow behaving exactly as expected. Because when expectations move faster than reality, markets do not immediately correct. They wait. And then, eventually, they adjust.